Imagine waking up tomorrow to find the cereal aisle picked clean, coffee priced like craft whiskey, and a single loaf of bread costing more than your streaming subscription. That nightmare is only a few harvest failures away in a world racing toward 9 billion mouths by 2050. Mouths that will require roughly 47% more crop calories than we produced in 2011. Here's the kicker. According to the United Nations and the U.S. Department of Agriculture, global food demand is on track to soar between 70 and 100% over the next quarter century, even as farmland shrinks and weather grows wilder. That mismatch between appetite and acreage is creating one of the century's biggest economic pressure cookers, and for prepared investors, an equally outsized opportunity. Stick around for the next 8 minutes and I'll walk you through how agricultural exchange-traded funds, Ag ETFs, let everyday investors tap into the planet's oldest necessity with the click of a button. You'll learn the difference between owning the tractor, the tomato, or the very dirt beneath them, the hidden fees that can eat your gains faster than locusts, and a practical 3-step crop check that will leave you ready to sow smart and harvest confidently. First, what exactly is an ETF? Think of it as a ready-made fruit basket on the grocery shelf. Instead of buying apples, oranges, and bananas one by one, you grab the basket and own a slice of everything inside. Agricultural ETFs do the same for farming. Some baskets hold shares of agribusiness companies, others hold futures contracts on crops or livestock, and a few mix and match. Either way, you get diversified exposure wrapped inside a single ticker that trades like a stock, settles like a stock, and clears in seconds. Let's separate these baskets into 2 aisles. Aisle 1, Agribusiness ETFs, the boots and bolts funds. Ticker symbols like MOO, VEGI, and FTAG own the companies that supply the seeds, fertilizer, machinery, and data science, turning modern fields into high-tech factories. When Deere unveils a self-driving tractor or Nutrien signs a massive fertilizer contract, these ETFs capture the upside. Many of those companies pay regular dividends, so holding an agribusiness ETF can feel like plugging your portfolio into a slow, steady irrigation pipe. Aisle 2, Commodity ETFs, the pure crop play. Funds like Invesco's DBA, Tucarium's wheat, corn, or cane track futures on grains, oilseeds, and sometimes livestock. Owning one is a bit like buying a virtual granary. When wheat prices jump on a drought in the Midwest or sugar spikes after a Brazilian frost, the value of the fund usually rises in sympathy. But commodity ETFs are fickle friends because most roll their futures monthly. Phenomena like contango, where next month contracts cost more than the current month, can quietly nibble away returns like mice in the grain bin. So which aisle deserves your shopping cart? Think of agribusiness funds as planting a long-lived orchard. You'll ride the sector's structural growth, think rising Asian protein demand and the march of ag tech, while collecting dividend fruit along the way. Commodity ETFs, by contrast, are more like renting a roadside fruit stand. Your profits depend heavily on the season. Bumper crops can flood the market and crush prices with the speed of a summer hailstorm. For that reason, many pros treat commodity ETFs as tactical tools rather than forever holdings, sprinkling them in when inflation fears or supply shocks loom, then trimming when calm returns. But no matter which basket you choose, remember every farm faces pests. FINRA's latest oversight report reminds investors that complex structures, high expense ratios, and thin trading volumes can plague specialty ETFs. Always inspect the label. Look for funds with at least $100 million in assets, bid-ask spreads under 0.25%, and clear disclosures on how they roll futures or select stocks. Now to the big debate. Will agro protect you from inflation? A 7th-century study published in the Journal of Alternative Investments found grains like wheat among the strongest historical hedges, though their relationship to consumer prices has weakened since the mid-20th century as energy captured a larger share of the CPI basket. Translation: agriculture can dampen inflation's sting, but it's no silver bullet, more a sturdy barn than an impenetrable fortress. With the theory tilled, let's roll up our sleeves for the hands-on part, the crop check. Step 1. Exposure. Ask yourself what you're really buying. If you already own plenty of industrials and chemicals, a commodity ETF offers diversification. If raw crop swings unsettle you, an agribusiness ETF's steadier earnings might help you sleep. Step 2. Costs and liquidity. Compare expense ratios. Broad funds like VEGI charge around 0.39%, while single crop products such as WEAT can top 2.8%. Make sure average daily volume tops 50,000 shares so you can get in and out without slippage. Before we move on, remember that the next wave of agricultural profits may sprout from technologies that barely existed 10 years ago. Picture fleets of drones mapping nitrogen stress over thousands of acres, sensors buried like cyber earthworms reporting soil moisture every 15 minutes, and vertical farms stacking lettuce like data servers inside neon-lit warehouses. Agribusiness ETFs such as VEGI and KROP zero in on this ag-tech frontier, capturing companies that build autonomous sprayers, CRISPR-edited seeds, AI-powered logistics software, and even lab-grown meat platforms. These funds don't just bet on bigger harvests, they bet on smarter ones. The difference between swinging a scythe and wielding a laser scalpel. If sustainability and innovation are factors you want to overweight, sprinkling a small position in an ag-tech ETF can add an innovation premium to your core holdings while aligning with ESG goals. Want even deeper roots? Pair your ETF picks with farmland real estate investment trusts like Gladstone Land or Farmland Partners. Those businesses buy working farms and lease them to growers, passing rent to shareholders. Because lease rates often adjust with crop prices, farmland REITs can rise when both real estate and commodities inflate, offering a third layer of diversification. Sprinkle in a water infrastructure ETF, and you've built a miniature ecosystem spanning seed to supermarket. Here's a practical scenario. Say you're a 35-year-old saving for retirement with a moderate risk tolerance. You might allocate 2% of your portfolio to DBA as a tactical inflation hedge, 4% to MOO for growth and dividends, and vow to rebalance annually. If grain prices moonshot, you'll trim DBA back to target, crystallizing gains. If they tank, you'll add at lower prices, an automatic value-buying discipline called rebalancing. Of course, nothing grows without sunlight and patience. Dollar-cost averaging, investing a fixed dollar amount at set intervals, can smooth the inevitable lumps in commodity prices. Using limit orders when buying thinly traded funds protects you from paying above market prices. And always keep an eye on macro weather. El Niño and La Niña events, new sustainability regulations, or shifts in biofuel policy can all whip agricultural markets faster than the wind over a Kansas wheat field. Let's land the plane, or park the combine if you prefer. Humanity's demand for calories is non-negotiable. Whether we're grilling steaks in Texas, steaming dumplings in Shanghai, or making plant-based burgers in Berlin, the world will keep eating, and farmers will keep innovating to meet that hunger. Agricultural ETFs offer a simple doorway into that perpetual story, letting you invest not just in what people want, but in what they physically need every single day. Plant wisely by diversifying across agribusiness, commodities, and if it fits, farmland itself. Water your holdings with regular research, prune away fees, and stay alert for market-moving weather and policy shifts. Do that, and you may find your portfolio bearing fruit long after the latest social media fad is wilted. Just a heads up, nothing in this video is financial advice. It's all for information only. Thanks for taking this field trip with me. If you learned something new, hit subscribe, pass this along to a friend who still thinks money grows on trees, and drop a comment naming your favorite Ag ETF or Apple variety below. Until next time, may your gains be green and your risks well hedged.